Telmo Valido from the private equity side on the Hudson Advisors, Martin Rich, the co-founder of Future Fit Foundation, and Gonçalves from the S317 Consulting.
Yes.
So I welcome them all. This is a great topic, and I think it's the right step following the regulation discussion we just had before. ESG integration has just accelerated in the past years, and we see things like use of proceeds bonds, sustainability-linked loans, thematic funds with all sorts of ESG-related criteria. We see that more and more investors are integrating investment criteria related to ESG topics into their investment structure. But most importantly, what we probably need to debate today, and this is a starting of a provocation to our fellow panel members, is that for investors, the crucial factors are risk and return. And so the question is, should we give up risk? Should we give up return? Should we even give up liquidity on the investments? And if we don't, how can we convince investors to participate, to be part of the change? From a traditional perspective, the risk return is obviously the big criteria to decide an investment. So new things arise in the last couple of years, such as ESG rating agencies that try to score assets and investments and issuers. To a large extent, the public sector and the central banks have been also participating in a debate, trying to shed some light on how these criteria should be integrated, and especially launching to the debate things like sustainability and climate change risk. So obviously ESG is an important risk factor, if nothing else. And with that, I will probably give the floor to Professor João Pinto for a small presentation. Good afternoon. The floor is yours. Thank you.
Hi everyone. Let me just share my screen. It's okay now? Yeah, it's fine. Okay. Hi everyone. Let me just starting by give you some background regarding my presentation. So, different countries across the world have adopted new initiatives aiming at a gradual transformation to greening in their financial systems by repositioning their investments, I would say, towards an inclusive net zero carbon and resilient economies. So according to the World Economic Forum, 4 to 5 trillion US dollars investments will need until 2030. So this raises the need for discussion about how to finance these projects in line with what Carlos was mentioning, particularly in the context of capital rationing. So under this framework, ESG ratings play a key role in the process of obtaining financing, particularly for debt. And in addition, a number of new players have entered the market with a very relevant role, for example, in the certification process, like the Climate Bonds Initiative. Under this framework, this presentation focuses basically on 3 topics. First, what are the key sustainable finance instruments that organizations can use to fund sustainable projects? Second, the motivations for firms using sustainable financing instruments. And finally, I will try to interconnect ESG and SMEs, which play a very important role in European markets. So starting with the first point, what I say is, here you have a figure where I try to map all the sustainable finance instruments and solutions, starting with equity versus debt, then inside debt, splitting between market versus bank debt. And I'll say that if you look to the bottom on the left, you have structured finance transactions as the new instruments that can be used to, I think that it is the time to look to these instruments also in order to expand the market and help to broaden the investor base. But when we focus on equity, as you can see, you have the green funds, investment funds, private equity, venture capital, family offices, crowdfunding. So what you have here is typical equity instruments, but they are now used to fund sustainable projects. So that's what you have. When you move to debt, and you have this taxonomy regarding debt instruments, so green bonds, transition bonds, climate bonds, social bonds, sustainability-linked loans and bonds, or green loans, factoring, reverse factoring, lease. Again, what we have here are traditional fixed income instruments that are used with a specific background, framework, and focus on sustainable projects. And again, at the end, we have some structured finance transactions like green securitization, green project financing, which has been play a very important role in funding capital-intensive projects, mainly green projects, which I think it is the time to start thinking on this kind of instruments to raise capital for new projects. When you look to the market, what you can see here is that, in fact, sustainable equity capital markets grew significantly since 2018. But in the last, I would say, 3 to 4 quarters, there is a decrease in the volume. As you can see, in the first half of 2022, equity capital market activity of sustainable companies totaled 40.1 billion during the first half, but with a decrease of 42% vis-a-vis 2021. And when you look to the bond market, what you can see is, again, a huge, I would say, exponential increase of sustainable bonds. But in the last year, we have a decrease again. Okay, so you have a 23% decrease on bond issuance compared to the first half of 2021. And when you try to split this bond volume per product type, what you can see is that while we have a small decrease of 4% in green bonds, in fact, we have a huge decrease in both sustainability bonds and social bonds. And moving now to loans, again, the same pattern. So we have a significant increase in syndicated loans closed, sustainable syndicated loans closed in the worldwide market. But again, there is a 11% decline compared in the first half of 2022 compared to the first half of 2021. So in short, what you have is that in the last, so I would say in the first half of 2022, have a decrease in the issuance of sustainable bonds or even in the closing of sustainable linked loans. And first and second, sustainable financing instrument markets are small or when compared to the entire market. As you can see here, the sustainable equity market represents only 5.9% of the global equity capital market, 8.8% for sustainable bonds, 13.9% for sustainable syndicated loans. So here, or based on this, I think we have to raise at least 2 questions. The first one is, how can innovative financial instruments overcome some of the challenges and help broaden the investment base? And second, what is the role of multilateral development banks like the International Monetary Fund in leveraging private investment and providing risk absorption capacity? And for sure, they have a very important role here. Now moving to my second point. So what are the motivations for firms using this kind of instruments? And if you look to the literature, we have basically 4 different motivations. And the first one is cost of capital. So firms use sustainable financing instruments to reduce the cost of capital. So this is a theoretical argument. But in practice, when you look to empirical studies, what we can see is that for both bonds and loans, bond and loans credit spreads do not differ significantly between green, for example, and similar no-green bonds, or between sustainable and non-sustainable loans. So firms do not use this kind of instruments to reduce cost of borrowing. So a new question, how can policymakers create forms of positive discrimination to encourage the use of these instruments by companies? Should we have the ECB defining a new program to buy assets, for example, in order to create some form of positive discrimination? Perhaps it might be a solution. We have to discuss this also. But if firms do not use sustainable debt instruments to reduce the cost of capital, so what are the motivations? And here you have the three other or additional motivations: liquidity and funding sources diversification. This is clearly a motivation. And then you have signaling also. So empirical studies support the investor attention channel. But here we have to be very, very careful, because I think there is a very tenuous line between signaling and greenwashing. Okay, because and greenwashing comes in many flavors. For example, companies may use selective disclosure, dubious eco labels, misleading visual imagery, misleading narratives. So I have lots of different greenwashing types. But we need to also to assure that firms are not using this kind of instruments to go ahead with greenwashing. My final point is related with ESG and small and medium enterprises. So, and questions here, in my opinion, are knowing that in Europe, 80% of GDP contribution comes from SMEs, how can we influence the behavior of these firms? How can best practice be trickled down to SMEs? Should they have the same standards? What should be the long-term ESG standards for SMEs? And here I think that, on one hand, requirements on disclosure standards for these firms is crucial. So, and on the other hand, SMEs need to be supported on this journey. So the big reflection that I think a big reflection has to be made here is on how to make the complex discourse simpler and more accessible to all kinds of companies, without losing the core of systemic thinking and scientifically robust sustainability principles. So overall, what I think is that more than ticking the ESG box, we need to invest with impact. And I think, and this will be discussed further in the third panel, but I think that we need, in fact, to focus on how to invest with impact.
Well, thank you, João. It was very insightful. Thank you so much. Maybe a round of applause before moving on. Thank you so much.
Thank you.
I will just kickstart the discussion. Maybe if Telmo is online, are you listening to us?
Yes, I am.
Hello, good afternoon.
Can you hear me?
Maybe we can kickstart on your side, from a private sector side. How do you see ESG, sustainability integration into investment decisions? What's your take?
Yes, thank you very much for having me here today. I have worked as a private equity investor over the last 15 years. And I've been responsible for ESG at one of the private equity funds I've worked for. So that does not make me an ESG or sustainability expert, but I can provide my perspective. I think a couple of points I'd like to make. One is when you look at ESG and sustainability or impact, they are two very different things. ESG, if you look at what environmental, social, and governance considerations are, and if you think about the indexes, the public equity indexes that include ESG companies, you're going to find there some of the largest oil and gas companies in the world, and you're going to find there the tobacco companies in the world. These companies, in my mind, are doing nothing to solve any of the problems, neither social, neither governance, neither the big environmental problems that we have. But they are well-run companies. So the ESG criteria, for me, would be a proxy for a reasonably well-run company. Will take care about some environmental topics, and they will have all the policies for social, and they will have a good board and governance. Okay, but that does not allow us to solve the problems. If we want to solve the problems of the world, be it environmental, social, and others, we need to invest for impact. So I agree with what was just said in the previous presentation. However, having worked in private equity in these 15 years, I have felt how first the introduction of ESG criteria into the investments, and now a number of other considerations, including what is coming from the taxonomy in Europe, etc., has made private equity investors more aware of these topics and driven by returns, primarily, at least some of them, or the main investors driven by returns. You can start to see that you get a better valuation in a company that has a good track record of sustainability. So with that in mind, some investors that you would not expect being at the forefront of these elements are starting to think, if I invest in this company, how can I create value from a sustainability perspective? What will happen in 3, 4, 5, 10 years when I sell it? Will it be considered still a good company? And in that sense, a lot of sustainability criteria will come into impact. So I think we are in a journey, and I can see that journey impacting mainstream investors in private equity. And of course, we have seen in the meantime as well a number of innovators and funds that are specialists in impact coming to the fore. I'm talking about the mainstream. Those are also moving because of the trends that we are seeing. So yes, I do think there is a positive impact from everything that is happening.
Thank you, Telmo. Martin, are you online? Maybe we can.
I am indeed. I am online.
Hello, Martin. Good afternoon. So
good afternoon, João.
From your point of view, is this enough? What do you expect investors to do? How do you expect investors to insert, let's call it that way, sustainability factors into their investment decisions?
Good question. Is it enough? No, we are absolutely nowhere near enough. If by enough we mean to achieve a sustainable future for humanity and the environment, the planet as a whole. I think it was very interesting. I enjoyed João's presentation very much, but I thought it was quite intriguing there that he quoted a figure for equity investments in sustainable companies. I would dispute that figure, and I would argue that figure is 100% incorrect, because there aren't any sustainable companies in the world, or maybe there might be one or two somewhere. But again, to me and the work that we do at Future Fit, sustainability is all about living within societal and environmental boundary conditions that we have to abide by if we are going to survive as a species on a flourishing planet. And today, many companies are damaging and continuing to damage those boundaries through their activities because of the social economic system that we're in. Great companies like Patagonia, they still cause harm. They are actively trying to cause as little harm as they possibly can. They're also trying to be regenerative in what they're doing. And that's fantastic. I absolutely applaud what they're trying to do. But it would still not be true to call them a sustainable company. And then, of course, there are many others that my colleagues have already referred to who are most definitely doing nothing more than sort of ticking boxes. So where do we need to go from an investment perspective? I mean, again, I think, the comment that João finished with in terms of investing for impact, it is absolutely right. So if I may take one more minute, what do I see as that meaning? I mean, firstly, it comes down to truly understanding and being transparent about the difference you're trying to make as an investor. And I think that's where a lot of the arguments that we've seen around the ESG space have come up. As the lady on the previous panel noted, it means, I think she said 270 or more different things. She's absolutely right. At the end of the day, you have to be taking into account some degree of environmental, social and governance risk factors as an investor. If you're not, then quite frankly, it's insanity. What are you doing managing people's money if you're not even considering those risks? But it's then about being honest and transparent about what is it you are trying to achieve. Are you merely trying to minimize your risk in order to maximize the return for investors? Fine, that's one approach. That's not going to save us all, but it's an approach. Or are you actually deliberately trying to invest in companies that are transforming, that are seeking to reduce their harm, ultimately increasing and only getting to the point where they're doing good, if you like, being regenerative, truly regenerative businesses? Or are you somewhere in between? That's what I really want to see, is transparency across the whole of the investment market so that the underlying investors can understand where their money is going, what type of impact the fund manager is trying to create. And so final point, I think the regulations, the reporting regulations and everything, again, which your previous speakers have talked about, yes, they're good in as much as they're trying to point us more in the right direction, but they certainly run a very substantial risk that people end up just ticking boxes, filling in forms, complying with regulation, rather than focusing on what they actually need to be doing as businesses, or from the investor perspective, simply aggregating and piling together a bunch of relatively meaningless data to just give you a set of aggregated, relatively meaningless data, which again isn't going to drive us in the right direction. So companies need to be far more clear and transparent about what they are actually doing and how they are seeking to transform. And the investors, be they banks, fund managers, private equity, whatever it is, need to be very clear on their objectives in terms of, again, are they just seeking to minimize risk and maximize return, or are they doing that in some combination of trying to help businesses transform in order to achieve better impact in the long term?
Well, thank you so much, Martin. It was very insightful. Anna, maybe I was expecting you to be a wall sitter here and maybe bridge a bit the two previous opinions. So what do you think? How could investors try to implement and deploy some sort of sustainability factors into their decisions?
So I think the most important thing that we need to provide investors are the tools to make the decisions. Because if they don't have enough information, then they won't be able to make those decisions in a proper way. I think, for example, the EU taxonomy comes with this in mind. And I think talking about what Martin just said about, it is true that nowadays companies have felt the obligation to fill out a number of forms, to report to a number of agencies to score their sustainability strategies and actions. And sometimes they're double work, they're duplicating their work with a lot of added value. But I think those tools are needed. And for example, the CDP, the Carbon Disclosure Project, was something that was created out of the necessity from investors to have a platform that would allow them to evaluate companies on their sustainability, specifically first climate change, but now they have moved to other environmental areas as well, because they wanted to have that information available so that they could assess the risks of investing in those companies. Are these companies aware of their impacts? Are they trying to minimize that impact? Are they aware of the risks and opportunities that come with these environmental problems? So these are the things that I think investors will need. I think they need the tools to evaluate risk. They need the tools to gather information for them because they won't have the time to question all the companies, but it needs to be in a standardized way. It needs to be done in a standardized way. And to your point, the EU taxonomy really helps on these, on how to establish criteria to evaluate these in a standardized way, in a transparent way that allows them to make decisions on if they actually want to pursue a sustainable investment. And I think there is a demand for that, but sometimes companies just don't know exactly how to do that.
Thank you. And finally, João, I hope you're still there. So maybe you can try to enlighten us a bit what you have seen so far, and how do you see so far companies implementing these sorts of sustainability-related factors into investment decisions? How do they monitor that? And maybe you can tell us a bit more about why you see this decrease and issuance of use of proceed bonds and sustainability-related assets.
Hi, I'm still here. Thank you for your question. Look, I think that first, as you mentioned in the previous panel, in fact, European taxonomy is focused on most on the environment side. Okay, you don't have so far taxonomy on social and government experts, and I think this is important. In addition, we know that we have a war, we have a huge price inflation problem. So everything with the bond yields increasing significantly, we have here a context that might explain such of this market evolution, these patterns. And regarding what Marnie said regarding how firms are trying to use this and moving to ESG factors, for example, I think that we need to say very clearly that ESG factors or scores or ESG investing isn't designed to save the planet, in my opinion. Okay? Look, the main argument is that ESG ratings, which underlie ESG fund selection, are based on single materiality. By quoting two friends from Harvard Business School, in fact, ESG ratings don't measure a company's impact on health and society. So they got the opposite. So the potential impact of the world on the company and its shareholders. That's my opinion. So, and they also bear no connection to natural boundaries. And I think that we have to have this in mind when we start discussing how investment funds, for example, are selecting assets to include in their portfolio based on ESG criteria and so on and so forth. So, and this, I think this is key here when we start discussing this.
Thank you, João. I'm glad to see that everybody is mentioning the taxonomy, for instance, also ESG rating agencies. That's exactly my next question. So we've seen that lately there's this increase of ESG rating agencies. Of course, there's demand for that, as all of you mentioned, but there's a lack of harmonization within their methodologies. I highly suspect that will be regulation coming to harmonize those ESG rating agencies too, but I think that's another topic. But the question here is, what's the role of ESG rating agencies? What's the role of agreements like the UN PRI, so the United Nations sponsored Principles for Responsible Investment, the role of these net zero alliances? How can they contribute for us to better trust and for investors to be more confident that they're investing into what it's widely considered sustainable? And of course, we already mentioned the part on the taxonomy. So maybe Telmo, can I start with you? What do you think about these ecosystems surrounding investors?
Look, I want to be positive about this. I I think that, as I said, if I take 5 years ago or 10 years ago, inside the doors of many of these private equity houses, but I think also inside the banks and inside public equity investors, asset managers, ESG was possibly a consideration, but maybe it was not even a consideration. Today, I am sure that there's no investor in Europe right now that is not thinking about an investment that does not at least have a conversation about sustainability. It may be the wrong conversation. I agree with the views that there's a lack of information, and we as investors are presented with opportunities and have a hard time understanding whether that company has a positive impact or a negative impact, and to what extent that impact exists. But the conversation is going to happen inside those investment committees these days. I am absolutely convinced. Okay, so I believe that part of the role that some of these organizations have had is to bring some frameworks to those conversations. Are they correct? Are they 100% right? I am sure they are not. I have experienced it myself with having invested in a company. We have decided to go for an ESG rating for that company. We consulted 3 or 4 companies, and the ESG rating is different for all of them. So it's like, okay, it's difficult. But what it triggers inside the company was a lot of strategic conversation, was actually a discussion about product development. What is the next product the company wants to develop? There was a conversation about investments. What is the capex that we want to make, and where does it take us? There was a conversation about organization, where we got the talent inside the organization that knows about sustainability. Are we going to create a new department? Are we going to make it inside the current operations? All of these discussions happened, and I think this was very important. Now, it does need to move from, I think, as mentioned before by Martin, from that transparency around whether we are just trying to not do harm versus is this a company that is made to solve the problems that we have, so a positive impact. And we need to bring that information to a completely different level. I say it myself, I've looked at, over the last 12 months, companies in packaging, and I have no idea. If you talk with the glass guys, they're going to say glass is the best product. You talk with plastic guys, they're going to say they're green. And you talk with the paper companies, or you talk with the Tetra Pak, which I understand, sorry to mention the brand, but I understand is not even recyclable. And they will get the best ESG rating that you can find in the industry. So it's very difficult. What can we do to make it right? But so I do think that the information and the transparency needs to increase materially, very, very materially. It's a change of a completely change of domain. But I think these organizations have provided frameworks for the conversation to reach the point where we are today, and I think that is very important.
Thank you very much. So Martin, we've seen that this is not being easy for companies. Some of them are actually honestly interested and making an effort to come with a more organized and structured approach for their investment decisions. So do you think, what would be good enough for you in terms of monitoring tools, ESG rating agencies, taxonomies? How do you see that, Martin?
So I think, firstly, the double materiality perspective, particularly that we're seeing coming through the EU taxonomy, is incredibly important. And just quickly back to your previous question, was how can ESG ratings help companies be more sustainable? And João sort of already gave you the answer to that indirectly, and the answer is they can't in any way, shape or form. Why? Because they are only focused on financial materiality. They are outward in ratings. that does not in any way, shape or form help a company to be more sustainable. You cannot consider the sustainability of a company without considering the inside-out impact on the world, by definition. So until ESG ratings or whatever we end up calling a new set of ratings start to look at the double aspect, the outside in and the inside out, can we actually have any meaningful picture of what a company is doing? So ESG ratings today are, quite frankly, in my view, not particularly fit for purpose. I don't really care whether they all come together or not. I can see the advantage in them doing that the same way that credit ratings have. But again, we've got to recognise the limitations of them and make sure that we are using them in the way they are intended. Now, ultimately, then, to your questions just now and to Telmo's points, what then becomes good enough? Well, how do we guide companies in what it is that they need to be doing in order to be truly sustainable and to get rewarded for that and to be able to report on that and to be rated for that in the right way? I don't see that happening today. The EU taxonomy is making strides in that direction. It's far from perfect, as has already been discussed, and I think it's got a lot of problems, but at least it's trying to take a step in the right direction, and it's trying to encourage companies to report around the right things so that then again the investors can come in and say what they are doing. But ultimately, we need frameworks and approaches like EU taxonomy, like Future Fit, and what we've tried to do with the impact materiality mapping is to show them how to actually be moving in the right direction, how to stop doing harm, how to become truly regenerative, and then for the investors to be able to reflect that truly in their portfolios and align that with their objectives and missions as investors.
And Anna, from my professional experience, I see that the methodology on the rating agencies is quite different. Actually, some of them, they do have a difference between inside out and outside in approach, but the methodologies are very hard to understand. So how do you see this? How can we make a monitoring tool to make everybody more confident?
And I think this comes back to the point of what we were talking about before, the importance of standardization and normalization between the ratings. And because if we don't have the same way of rating companies, how can we even monitor if the starting point is different? So I think having a standard methodology that could apply to these ratings is an important first point to move forward. Then going from there, the monitoring, I think it needs, with this methodology, we need to set what is good enough. Sometimes, as it was mentioned here before, some companies have great ratings, but they're only doing things that for their own interests in a way that it's not, which doesn't have a net good impact for the outside world. They do things for their financial interest, not because it's the right thing to do. So I think we need to establish what is those ratings, how to classify what is good enough and what is not good enough. And I think this comes to the point of taxonomy, and I'm kind of almost sorry that I come back to this over and over, but it is a good framework on how to work things and how to evaluate things, because it sets a methodology that can be applied to a number of sectors, and it creates standards and thresholds on this is what is good enough for you to label this as green. And this is for the ESG frameworks is a bit more complex, because the social part, we all know that it's a bit more, well, less tangible. So, but it is important to understand the materiality, the double-sided materiality that was also mentioned here, and what are the actual impacts that we expect from the strategies that are set by the companies. And also, to help companies doing all of this, I think we actually need to also think about capacity building. I think a lot of the companies don't actually even know how to do this. Some companies are very willing to move into this area and they look at sustainability, but they don't even know exactly how to do this. So capacity building is also another important part here that I think it's needed. Tell people, tell companies, and we have worked with companies, we have talked with a lot of companies that now want to do their ESG report, do their sustainability report, but the first thing that they think of is the actual report, when the actual report should be like the end stage. So I've done all of this work and I'm going to report on what I've done, but they think on it the other way around. Okay, I want to report, and we tell them, this is actually what you need to do to get there. And they're kind of surprised. And so, because they don't understand the journey. And I think this is a very strong, a very important part of this whole area. It's actually capacity building and helping companies in this journey.
Thank you very much. And João, just to finalize this topic, I'm sure you looked into a lot of details of these companies for your work, and I'm sure you understand a lot of these reportings. Do you think issuers, funds, investors are just riding the wave of this vibe around green bonds, green theme, environmental related investments, or there's a change behind? And do you see any of these commitments that most of the companies or some of the companies do having actually a change in their issuance profile or financing profile?
Yeah, in fact, I see that we have two sides of the space. So we have firms that in fact are investing with impact, and other firms that are just saying that they are more green, more sustainable. And that is very, very clear for me. And even when we try to understand what are the motivations on the firm level, motivations for public firms to use this kind of sustainable financing instruments, it's quite interesting to see that sometimes those for the large firms for sure, and those with more leverage or even with a higher credit risk level are those that go or use more extensively this kind of funding instruments. And it shows that in fact much of the firms are in fact using this not to invest with impact, but in order to, I would say, go entering in some greenwashing processes. And this is quite preoccupied. In this time, it is quite. We have to be very preoccupied about this.
Thank you very much. And the last round of questions, I will ask maybe a very quick answer if possible. The question is obviously related to risk and return, and I will go first to Telmo. Would you eventually consider at any point moving upwards the sustainability factor over risk or return?
We are given money by our investors with a certain mandate. So within the current mandate, no. And that was not why we were given the money. However, so the 2 points to that. Personally, yes, I have made my choice personally as where I put my own money, and yes, I have considered sustainability above returns personally. But for the organization I work for, that's not the mandate. However, I do not think there's a those are two different things. I just don't see how we can make money on the basis of destroying the planet or destroying humanity on this planet. So I think the two things will eventually come together, and they will be one and only. But yes, so I think I answered your real question. No on the present mandate that we have.
Thank you very much. And Martin, I think the question for you is quite the other way around, is how can we convince investors to move upwards the sustainability factors? I think the ECB made a step towards that by calling climate risk change as a main risk on the medium term. Of course, most people would consider, some people consider longer term, some more shorter term, but how can we convince investors to move upwards these factors?
I wish there was an easy answer. It's what I spend most of my life trying to do. There was a fantastic cartoon in the New Yorker a few years ago, which perhaps people will be familiar with, which is of an old man and a young child sat around a fire with the smoking ruins of society in the background. And the caption says, yes, we destroyed humanity, but we made some great shareholder returns in the intervening period, or words to that effect. So, you know, I'm going to take the big picture view here and say that there is no business to be done on a destroyed planet. Ultimately, you know, we will all go to hell pursuing the best returns we can possibly can, hiding behind the fact investors gave us money, you know, to maximize the returns on. We need to be creating a society and a socio-economic system that is truly sustainable. We are committing suicide by continuing to run a global socio-economic system that isn't sustainable. So ultimately, these two have to come together. Either they will, and we can persuade people of that view, and I think it's an intergenerational shift. I think there are too many folks who are hardwired to doing things the old way. I think the younger generations want to see things change, and I see my role and those of others who are similarly minded to help that transition and create a future socio-economic system that really is fit for purpose. Whether or not we'll be successful, I suppose if we are, we'll be here to look back and respond to this positively.
Very much. And Anna, I suspect that carbon market may have something to do with this. Would you link the two?
Yes, so that's actually my presentation next.
I'll leave it to, I will not want to...
So I think here with the carbon markets, and I think here we have two carbon markets. We have the voluntary one and we have the regulated one, and this works separately. And the regulated carbon market, of course, there is this risk, even investment risk. If you have investments ahead of you, you will have to come up with a carbon price. You have to think of the price not only now, but in the future. So you have to embed that into your strategy, in your investment options. For the voluntary carbon markets, and there is some say that the two will merge at some point in the future. I don't know. They work in a very different way. So, but there is this part that carbon markets, the voluntary carbon market is there more as a financial tool to promote these kind of investments that are too risky. So this more like, it's more to incentivize the returns, to increase the returns, to promote this type of investments, and to decrease the risk of this type of investments. So it comes as a mitigation of the anxiety of promoters and investors on these type of projects that would often not make economic sense in a way. So it does have a role here too.
Thank you. We will wait anxiously for the presentation for sure. And João, just to finalize, I would understand that we would shift from the traditional finance models in which we maximize returns subject to minimizing risk, sometimes even the other way around. But how do we incorporate these new factors when we want to maximize company value?
Look, my answer is, I think, might be completely related with the role of asset managers and the topic that we'll discuss in the next panel. But clearly, we have to do that. Look, We know that, for example, asset managers have the power to influence corporate behavior, mainly if they make their investment decisions based on ESG, for sure. And there's more than just a relationship between risk and return, in my opinion. So a third dimension, impact risk, needs to be embedded into the investment process. Only by considering these three pillars together can we uncover the asset's real investment potential and achieve the best outcome for society. And for sure, active ownership is also a core part of this. But we also need to use the, I would say, the old finance tools to adjust them in order to apply to this new or the evaluation of these new investment projects in order to compute the real value, economic value created, and not only focusing on the financial value. We need to go further and to think on economic value, to think on trying to think on the business surrounded by the society and the environment, and not thinking on the business with touching points between or with the society or with the environment and so on and so forth. So only when we think holistically, I think we will be able to value correctly this kind of projects and choose the best investments, again investing with impact.
Well, thank you very much. And first of all, I would like to thank this amazing panel. I think it was an incredible debate here. And now I think we're going to have a final presentation which will probably give another perspective regarding what's going on in the market and most likely how carbon markets will affect the sustainability factors also in the companies. So Anna, the floor is yours. And thank you to all the panelists. Thank you so much.
So as Carlos said, thank you for the introduction. As Carlos mentioned, I'll give you, what I think is a complementary presentation on what was just discussed here. We have discussed on the investment markets, financial markets. Here I'll talk about the specific markets that is works almost in parallel to the traditional financing markets. And voluntary carbon markets, I don't know if you know this, but it's quite polemic because some say it's very much attached to greenwashing, but I believe that it has a big role in the future, and I will explain why. So starting at the top, companies are defining their ESG strategy. It covers environmental, social, and governance, and actually carbon markets can touch in all of them because there are some requirements for governance and social impacts of the projects that are included here as well, but I'll focus here on environmental because that's the main focus of these markets. When we talk about environmental management of a company, we talk about many aspects. We talk about energy management, water management, resources, waste, and they're all interlinked. But actually what captures all of this is carbon management. All of these energy, waste, resources, water, the way we use them, the way we manage these will have an impact on the carbon emissions of a company. And recently, with the ESG now coming at a focus for companies, companies are thinking what are my environmental impacts, and they're now focusing a lot on carbon. A lot because of this, because it encompasses everything, but it also because it is current. Everyone talks about climate change, so everyone talks about our carbon footprints, and we want to know how we can mitigate it. So in this line, a lot of companies are saying they want to become net zero. I want to become a net zero carbon company by 2050. But what does this imply? Does it mean that there will be no carbon emissions? Actually, no. There will be for sure some carbon, some reduction in the carbon footprint, but we cannot reduce our footprint to zero. That would be almost impossible. We can try, and we are getting there, but it's almost impossible to reduce it. And so the remainder of the emissions, we have to compensate for them. That's basically how we define carbon net zero or carbon neutrality. My background passed a bit by certification at some point in my life. I work in certifying companies if their carbon management was good or not. And maybe because of that, I always look at the standards to look for definitions. Because net zero, there is a mention of net zero. Some companies say that they want to be carbon neutral, so what's the difference? Because there is a bit of a difference. Carbon neutrality, companies have to show a reduction. It can be 0.5% of their footprint, it can be 5%, it can be 50% of their footprint. As long as they set a target to reduce their emissions and they've achieved it, and then they offset the rest, then you can claim that you're carbon neutral. But for net zero, and here I'm using the definition by the Science Based Targets Initiative, companies need to reduce their whole footprint, and by whole footprint, I mean their operations, the impacts that come with their operations, their value chain, and by value chain I mean their suppliers, their clients, their business travel. Everything that they do has an impact in carbon emissions, and that has to be reflected in their footprint. And taking all of these emissions, they will have to reduce it by 90%. This is a very demanding target. But still with that very, very demanding target, we are still left with 10% of emissions. We have to compensate them somehow. And let's be honest, if we want to achieve the 1.5 degree world, that's what we are trying to do right now, where climate change impacts are not as severe. We will need not only to reduce our annual emissions, but we will also need to remove emissions from the atmosphere. We will need projects not only that reduce the impact of our actions, but we need also projects that will remove CO2 from the atmosphere. These projects are often very expensive and with very low rates of returns, if any, to be honest. We have two types of solutions. We have technological solutions to remove CO2. These are very, very expensive and still at early stages in the technology readiness level. Some a bit more advanced, but overall, still very early days for this, and very, very expensive. And we have the nature-based solutions. Most of the cases, we're talking about reforestation, protecting forests. We are talking about looking at burned areas, for example, burned forests, and forest them again. So the carbon credits come here as that important role. They're actually created, the voluntary carbon market was created as a financial instrument to move money from developed countries, the countries from, that had a lot of money to invest, for developing countries, for them to promote programs to protect or to increase their forests, or to promote programs for energy efficiency or for fuel switching to greener forms. So the voluntary carbon market was, from the start, a financial mechanism to move money to things that wouldn't happen if the carbon credits wouldn't exist. And it's still so nowadays. We now have voluntary carbon markets defined in California, in Spain. In Spain, the carbon market is mostly focused on forests, because that's what the solutions will the most readily available solutions are to actually capture emissions, these nature-based solutions. So these carbon market, these projects have the offer part of the market, and then there is the demand. With these increasing claims of net zero, we are increasing the demand so much that the price of carbon credits for nature-based solutions has actually increased from €5 a ton to €15 a ton in just a quarter or half a year. And it's been stable for a long time, relatively stable, but it has increased a lot in recent months. But there is the other side of it, of course. There is a big risk of greenwashing. And there is related with a number of things. It is related with communication, not using credible platforms to buy your carbon credits. And it's related with just relying on offsetting. We now see a lot of events saying they're carbon neutral. I haven't seen them all, but I can assure you that probably most of them are greenwashing. A lot of them. If you go to an event that says, let's plant trees and offsets your emissions, that's great for team building. That's not great for actually having an impact. These kind of programs have to be big, have to be done in a kind of a professional way, and they have to be monitored. Because planting trees is great, but in most projects, more than half of the trees die at the end of 1 or 2 years, because there's no actually management of what was done. So I just here have a set of examples of just a few news that came out recently about greenwashing. And for example, what I was just saying about events, it can be linked here, not working. With FIFA World Cup, they're saying they're carbon neutral, but with all the concerns about environmental issues and social issues, their claim that they're carbon neutral is it's very much linked with greenwashing. There are also concerns that, as I mentioned, we have to look at our whole footprint, and there are concerns that they're actually, these emissions are too much, so I'm just focusing on these ones, because these are more manageable. So they're not looking at the whole picture like they should, they're just focusing on what they could manage. EasyJet as well. They mentioned that they're stopping their offsetting carbon credits buying program, their offsetting program, because they want to focus first on reduction. This historically, and I think you've all flown, you've all bought air tickets, there is a small box that says, do you want to offset your flights? You do a tick, you pay probably 1 or 2 extra euros for your flight tickets, and then you're offsetting your emissions. But that's only half of it. As I mentioned, there's no carbon neutrality, there's no companies shouldn't claim that they're carbon neutral, they're net zero, if they're not focusing on reductions first. That should be the first priority. And that's what EasyJet mentioned. We don't want to focus on the offsets, we want to focus on the carbon, on the reducing our carbon emissions first. Regarding communication, HSBC, this is actually from last week, I think. They had an advert linked with COP26 that mentioned how good their investments were, how green their investments were, that they were investing 1 trillion in sustainable projects, but they forgot to say how much they were actually investing in non-sustainable projects. That's a mission that's only looking at one side of the story made them actually be the object of many complaints, and the advertising regulator in the UK actually banned those adverts from appearing in public. And also, of course, in America as well, there's a strong push for increased regulation to actually understanding what are these carbon offsets. Another point that is not here, it's related with the credibility of the carbon offsets. So I don't know if you know John Oliver, a comedian entertainer in the US. He has a weekly program called Last Week Tonight. It's really cool. I don't know if you know it, but it's I advise it. And he always runs like a 20-minute piece on some theme. He did Trump a number of times, of course. He actually did recently a piece on the Brazil election. He covers American themes. And this season, he actually covered one about offsets. And he trashed carbon credits. He absolutely crashed with real examples, people that had projects saying that they were going to protect or they're going to plant hectares of trees. Nothing happened, and they were still emitting those carbon credits, and they were still selling those carbon credits. So it's very important that the carbon credits that people buy are actually coming from well-known, reputable, and well-recognized platforms. There are a couple, so there are a couple like Vera or Gold Standard that provide that information. They have platforms where you can see all the projects, you can see the information about the projects, the verification. There has to be a process of monitoring to actually see that what you've said was going to happen actually happened. So it's not like, okay, this project sounds great, here's all the credits that you want, and we'll see you in 30 years. No, it actually happens like every 2 or every 3 years. There's a monitoring process to make sure that actually is bringing the impacts that was supposed to. And he trust him, I recommend it. But let's not lose hope, because there are ways of making sure that we are pretty much lowering our risks of greenwashing. One, this is mostly for companies, focus on reduction first. This is very important. There's no way for you to offset your whole footprint if you don't try to actually reduce it first. And this even makes economic sense. As I mentioned, carbon credits are becoming more and more expensive. So if you reduce your footprint, you're actually going to spend less in carbon credits. Then always look for carbon credits that are verified by credible entities. And last but not the least, create communication strategies that are actually aligned with what your company does. Don't overstate things, don't omit things, and always stick to what actually happens. So just a final point, carbon markets, and going to my initial point, the voluntary carbon markets is relatively dangerous. There are a lot of pitfalls, but there is a way around them, and it is one of the most important mechanisms that we have to finance projects that are important to the climate change fight that we're having. That's all. Thank you.